Hello everyone, my name is Clément Gignac and welcome to this Facebook Live. I will try to summarize in the next 5 to 7 minutes the webinar that we have just recorded for the benefit of our advisor and our clients. So the title of my webinar this month is Post-mortem 2019 and Outlook for 2020. So what a year, what a difference as well. We are in the December compared to a year ago. I don't know if you remember December 2018. I remember it was very bumpy, so a lot of volatility. As a matter of fact, December 2018 was the worst December ever since in the 30s. So last fall, the fourth quarter 2018 has been very painful, close to minus 15% for Wall Street. So we had been pretty early in 2019, if you remember last January, that we mentioned, come on, if we have no recession, okay, this is, yeah, it's bumpy, no doubt we have a huge and severe correction, but if we have no recession in 2019, using the past as a guide, when you have no recession, this kind of correction has been recovered the losses pretty quickly. And this is what happened, to be honest. It was even quicker than what we thought, because Wall Street recovered all the losses experiment in the fall 2018. It recovered in 4 months rather than 6 and 9 months. So it was very interesting. So what is the outlook for 2020? So we think that it will be on the economy a very decent year. Okay, it will not be an acceleration of economic growth, but we do not see any recession. Keep in mind, business cycle never die of old age. So what is the reason for a prolonged economic cycle? Let's start with the U.S. consumer. U.S. consumer is the biggest market on the planet. The U.S. consumption is bigger in terms of dollar spent than even the Chinese market. So this consumer remain confident. They have the lowest employment rate in 50 years. Inflation is under control. The Federal Reserve signal they have already reduced 3 times this year, and they signal they have no intention to increase interest rate, and they have a wealth effect as well. Keep in mind that we have this kind of performance of the market, with the stock market in U.S. has increased close to 25% this year. This is a huge wealth effect for the consumer and the household U.S. So for that reason, we think it will have a prolonged economic cycle in U.S. So some deceleration, because you have a fading effect of the tax cut that put in place in 2018. So we are optimistic. Looking about Europe, things improve. Finally, we have this UK election. We provide a majority government, so it looks like that the Brexit finally will be solved. They have some other issue to negotiate, but at least it seems that it will be an improvement of the business and consumer confidence, because Brexit, in fact, has affected the European economy and UK economy for the last 3 years. So we think that the euro will appreciate again the US dollar. Overseas, going to China, because China, as you know, is a very important market, and in fact is 30% of the worldwide economy. It's very important. So things decelerate, but make no mistake, 6% GDP growth is still very impressive. And they use the interest rate cut. They use some fiscal stimulus and spending spree to keep, in fact, the economy growing. So this is a positive development. On the trade tension between China and U.S., things has improved. They look like a truce. They have negotiated the phase 1 deal. So make no mistake, phase 1 deal is very minimal. So it's more than a trade war. It's a technology war as well, and military supremacy. So in such circumstances, it's not an easy fix. But at the same time, Mr. Trump is very realistic. He knows he have an election coming. He wants to be reelected. And never a president in the U.S. has been reelected if you have a recession and a bear market. So that's the reason I think that Mr. Trump seems to put this stuff a little bit on the back burner. If he wants to be reelected, he have to come down a little bit on that topic. So this is encouraging. Talking about Canada, the Canadian economy performed well. This is on job creation, the best sequence ever seen in 17 years. In fact, this is interesting. That's one of the reasons that the Bank of Canada have never matched the rate cut that we have seen from the Federal Reserve. That should support as well the Canadian dollar in 2020. Talking about the capital market, so I mentioned that it's a very good vintage this year. 25% plus on Wall Street. TSX is close to 20% return. Even the bonds has performed very well, the fixed income. So it's surprising because, in fact, the economy continued to grow, no recession, and you have seen 100 basis point decline on the long rates, which is very impressive. So that's the reason that the bonds has performed very well as in that situation. So and the funds we manage as well as perform well in such situation. So looking ahead, do we have any fuel left into the tank on Wall Street? So after a 10 years bull market like that, the longest bull market ever seen since the 30s, yes, this is not the first time that you have this kind of vintage 20% plus on Wall Street. That happened 24 times since 1950. Guess what happened the following year when you have such vintage 20% plus gain? In fact, 80% of the time, the Wall Street continued to post positive growth, in average 13%. Okay, be realistic. I do not predict 13% return next year on Wall Street, but I think that we could have high single-digit growth. Why? Because first, the Federal Reserve is on the back burner. They have proceeded with rate cut, which stimulate the economy, and that helped for the price earning expansion. The second one is the PMI, the manufacturing sector. Manufacturing sector represents only 20% of the economy, but manufacturing sector has been in the recession in many countries. And now, with the prospect of a truce on trade war and with the Brexit to be fixed, I think the confidence of the CEO will start to improve, and that will help as well the market. So where we invest in U.S., overseas, emerging market, in our webinar, and I invite you to consult the document that we have attached to this video. In fact, we think that U.S. will have a positive return, but clearly we think that the dominance of U.S. stock market, because the U.S. equities has performed much better than the other market over the last 7-8 years, probably it would be a more hostile environment for them in the coming 2 years. Reason is because all the FANG will have now to deal with the regulators in Europe, regulators in Asia, and they have to will probably forced to pay a bigger share of taxes to finance the fiscal burden, the social safety net out there. So probably the fiscal burden of the FANG, so the Facebook, Apple, Amazon, Netflix, Google, will increase compared to what we have seen. So if we are right, that could create some headwind on the U.S. equities because they are much more grow in the U.S. equities than the other markets. So for that reason, we tend to underweight the U.S. equities and overweight EFI. We like very much Europe because I think the things will start to improve out there, and as well emerging market. Okay, emerging countries represent 55% of the global economic growth, but guess what? Emerging market represent only 13% of the global market capitalization, and they trade very cheap. They trade at 11.5, 12, 13 times forward earnings compared to 18 times forward earnings on U.S. And where the economic growth will come from in the coming decade, it will come from emerging market. So I think that it's a good time, particularly in the context that the Federal Reserve is out of the picture and probably the U.S. dollar will be under pressure. So all in all, we recommend to you to discuss with your advisor, because since each of us are different, we have a different risk tolerance, we have different objective. So in terms of investment or time horizon, that's the reason that we invite you to discuss with your advisor, and we are there to help you. So on that note, I want to thank you for your support. I wish you a very Merry Christmas and a good year 2020.